We are in uncharted territory here. And Michael, you brought up a good point. Never before have we seen a supply shock and a demand shock simultaneously. Given that, how do you navigate this market?
So as we were discussing earlier, there's just a cloud of uncertainty. You know, when bad news comes in, markets digest it. When good news comes in, markets digest it. When there's this uncertainty, we're directionless. And so as we're directionless, you are now in an environment where computers are pushing stocks around. Momentum, factor-based investing. When stocks go lower, they start selling more. When they go lower more, it's more and more and more. And then same thing to the upside. But on the downside, it just gets uglier. And that's for the simple fact that when your portfolio is down 5 or 6%, you tend to panic. When your portfolio is up 5 or 6%, I know very few, if anyone, who will ever panic from that. So the market dynamics right now, I just believe that there are not a lot of institutional investors, large players in the market, staking out big positions until we know what this coronavirus is going to look like.
Chris, let's get you in here. What type of actions are you taking this morning for clients?
Well, so we had talked about the last time we spoke, this two-way volatility, and I would agree with those prior comments that the amount of uncertainty is going to take a while to fully play itself out here. One thing that I would note is the relative trends that have dictated performance in structural portfolio construction for some time, things like the Qs outperforming SPYs or the SPYs outperforming IWM, that dynamic of large caps over small caps, those have been quite robust throughout this process, actually yielding to new highs in recent sessions. So it's important to note that that actually makes P&L implications of late a little bit less sinister than the headline indice moves would suggest. And so for us, we're taking a cautious approach. We're not out of the woods yet. Volatility is going to persist. This upside will likely yield to further downside. But ultimately, we do think this is going to stable out. Somewhere around 2,600 is probably the level where risk reward gets really attractive. So we would be using outsized dislocations as an opportunity to step in lightly, but knowing that the time frame that you're going to have to consider is longer than just the next few days or few weeks.
What are your thoughts, Alex? Do you think that today is going to represent a meaningful turnaround for investors?
Yeah, I think what you end up seeing in those types of environments is sort of these fears that investors have, right? So fear of missing out today, fear of loss yesterday, and you get these kind of trading patterns that really don't make rational sense in terms of fundamentals or really in terms of what's happening in the economy. So I think today we're probably going to end up closing maybe with half the gains of what we lost yesterday. And ultimately, we may see other news tomorrow that might cause a 1,000-point potentially downside right at the open. So it's very day-to-day right now.
Right. Michael, is the bull market dead?
No. So bull markets typically last for about 17 to 18 years. Bear markets about 12 to 13 years. And we'll use the last two, so 1982 to 2000. And then we didn't pass, so the S&P 500 hit 1,500 in 1999. We didn't get back there until 2013. So the way I look at it, the bull market started in 2013, and we're looking at a good another decade of this. That doesn't mean that we won't have bumps in the road, and events like that have happened with this coronavirus won't derail us for a short term, but over the long run, I tend to believe that's how the market's going to work going forward.
Jared Blickery, a quick over to you for a look at the world map.
Yeah, a lot of green here with a couple of exceptions. India down 5%, Tel Aviv down 6%. But for the most part, Asia's just slightly in the green here. We have the CAC 40 in Paris up over 2%, the DAX just under 2%, and London, the FTSE is up almost 3%. Here in the U.S., we got S&P 500 futures up 3 1/3%. Well, here's the year to date, and we can see that with this bounce here, just barely reclaiming some of the losses that we've seen here. And to Michael's point about liquidity and institutional participation, it's abysmal right now.
All right, there you have it. The opening bell ringing at the New York Stock Exchange and the NASDAQ. We may have a relief rally upon us, at least in the early going. The day is young. We saw stock futures rallying more than 3% heading into this trading day today. The Dow Jones Industrial Average off more than 2,000 points yesterday. It's going to start today on the plus side, though. And here are the headlines making the first trade front page. Italy is on lockdown. Its 60 million residents are being restricted to prevent the spread of COVID-19. Over 9,000 people have contracted the virus in that country. The White House House working on a stimulus program to help those impacted by the virus. The administration is meeting with House and Senate leaders to try to work out a stimulus package for workers and businesses who have been affected in some way. And the airlines in the spotlight, Delta and American, are scaling back their flights. They're making cuts as travel demand drops on coronavirus fears. JetBlue and United making similar announcements last week.
Alex, is the market screaming to everyone or trying to scream to everyone, we are in a mild recession right now? And if we are, some of these policy responses by the government, even the Federal Reserve, may not kick in and avert or drive growth in the back half of the year, as a lot of people think.
I think we needed the breather, right? So we're back into a territory where it's more attractive to put money to work. As active managers, we're seeing valuations get back to a level where we're actually looking to make some trades. So I think that's interesting in terms of the monetary policy and the implications there. That should help provide some liquidity to the market. It should help borrowing costs. We're already seeing mortgage rates dropping and starting to drop pretty dramatically. I think we're going to see more of that. We're going to see more monetary cuts. Are we going to go to negative interest rates? That's for prognosticators to figure out. I'm not going to put a bet on that currently, but I do think we'll go to zero by probably by the summer, early summer. I think in terms of fiscal policy, we're seeing a lot being done now by the administration, really responding here in the U.S., but also abroad and really everywhere else. I don't know that we've hit sort of the worst point of this yet globally. In the U.S., we're in the sort of early innings of COVID-19. And so it's going to be interesting to see how preemptively we can respond to this and if we can sort of kickstart the economy before we get to a rut or to an area where we go into a recession.
How worried are you about what's happening in the credit markets?
So, I think in terms of liquidity, the yields coming down is interesting. The 10-year, where it was yesterday morning, is scary for investors. But overall, it's really just an overreaction, and that's something that we tend to see fairly frequently from investors, right? Investors are not rational, they're not irrational, we're normal, right? We're not supercomputers, we tend to react in emotional ways. And yesterday when you already have the coronavirus, the COVID-19 issue in your mind, now you've got the oil prices hitting almost record lows or getting into that territory, you start overreacting. And to your point earlier, I think you have algorithms now that are trading and making things much worse very quickly without necessarily a rational thinking behind it. The last point that I'll make is in terms of news, right? We all have access to every single piece of information at our fingertips all day long. You didn't have that 10, 20, 30 years ago. And so reactions now are much more drastic, much more deeper than what they used to be in the past, where it was mostly managers that had all this.
Speed is staggering, right? The way we can go up and down with such speed. Chris, let's stick with the credit markets, because you say they are key going forward, especially the action we're seeing in the oil markets now. We need to worry about some of these energy producers perhaps not being able to make their loan payments and defaulting. How big of an issue is this, and can fiscal policy respond in any way?
Well, so certainly the credit spreads and their impact they had on the overall financial condition landscape is really what changes the Fed's reaction function to being more dovish. And we saw that with the emergency cut last week. The situation in oil is going to contribute to that. I believe it's about 13% of the CCC market is in the energy space. So it's a stressor for what are already pretty levered corporate balance sheets. What I think is ultimately going to happen on the fiscal side, which will be helpful, and this goes back to the point made just a minute ago about emotion, is that the markets have been caught in this real feedback loop where lower rates stoke more fear, and it becomes a bit self-fulfilling. So as we get through a slew of central bank meetings next week, hopefully the rate of change on policy to the downside eases, and you get that handoff from the monetary side towards the fiscal side in anticipation of activity picking up because of those fiscal levers being pulled. I think that'll actually be a very healthy thing. So that's what we're keeping an eye on here. The fiscal side of the lever is really what's going to be the driver of this going forward, offsetting losses in wages, helping to offset activity fall off, potential abatements in taxes based on lost revenues, et cetera. That's the kind of stuff that really is going to help blunt the impact of this demand shock that we're going through.
But Michael, we have interest rates now near zero. We have oil lowest in decades. Will disinflation become a problem? Will deflation become an issue? And what are the challenges for investors then?
So the problem with rates wanting to be so low and keep them so low is, do you turn the U.S. into Japan? That's going to be an interesting interesting scenario to play out on the interest rate side. Oil lower is inflationary. Right, this is not a deflationary. Event with oil. Oil lower it promotes more consumer spending. It's more money in the consumer's pocket. It's not good for these downstream guys that are triple C credits. Right, they're going to have some problems. The rest of America, this is good for us. And then just to pivot back to credit, if you look at where the VIX is and you look at a chart of the VIX and the triple B and the double B spreads, you've seen some moves in double B spreads, very little in triple B spreads, and those are the two areas I watch the closest because post-crisis, the rating agencies have just kind of thrown everybody into triple Bs, and kind of what used to be a single A / triple B is now maybe in the double B split rated. That's where the bulk of credit is, and you've seen very little moves in the triple B area right now. And I don't necessarily think these credit markets are shut off to a lot of these players because the fear hasn't really moved over.
This is not 2009.
Yeah, the fear hasn't quite moved over to the capital markets the way it has in previous, like say December, November 2018.
Well, Michael, you briefly mentioned oil companies. I was looking at a couple of stocks. Apache just slaughtered 50%. ExxonMobil, at one point, down close to 17%. Are those the names you back up the truck on?
Yeah, so ExxonMobil was yesterday was the lowest level since 2004.
Unbelievable.
They're not going away, right? This is a company, I think the yield's closer to double digit right now. Some of these companies that you're sure are going to be there, you buy them, stick them away. And how much is the XLE? Jared had that up earlier. I think XLE was up 8 or 9% earlier. Yeah. This is just the problem with these oil stocks is on the downside, you get a 1-to-1 movement. With the price of oil, and on the upside, you don't share that same participation, and it's been that way for a few years now. And I don't know if it's a glut of excess supply in the U.S., but it's you buy them for the yield. I wouldn't expect too much capital appreciation.
Jared, let's go over to you. You've got the Spider Energy ETF up.
Yeah, so it is up 5% today, 5.5%. Over the last 2 days, down 15, 16%. And that's kind of the similar story. We can take Oasis here, which is in the lead for our energy heat map. It's up 24% today, but still over the last 2 days, off 52%. So really not participating in the upside there. But we can also take a look at the NASDAQ. We can see a lot of the big cap stocks here. The mega caps are up decently. Apple's up 3.5%, Microsoft about similar, and then Amazon, Facebook, and Google all up more than 0.5%, but take Alphabet, for instance, still down 4% over the last 2 days. So the point is we have a lot of territory to make up in these flashy rallies that we get when we have or after we have these big sell-offs. A lot of times these occur within bear markets, so we're just going to have to slog through this.
Oh, wow. You mentioned the dreaded two-word term there, bear market. Well, let's leave it there, folks. Alex Piré, Michael Lee, Chris Pollard, Jared Blickery. Thanks so much, guys.
Right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.